This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 439 was produced on July 31st, 2024. I'm Eric Townsend. Commodity Context founder and energy markets expert Rory Johnston returns as this week's feature interview guest. Rory weighs in on all things crude oil, ranging from President Trump's claim that OPEC is working hard to get Kamala Harris elected to the ultimate growth limits of U.S. shale. We recorded this one just before the latest round of geopolitical conflict broke out between Israel, Iran, and Hamas. So I'll cover that news separately in our post-game segment. But Rory and I will still cover the longer-term geopolitical risk picture in the feature interview.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of July 31st, 2024. The September S&P 500 futures up 157 basis points, trading at 55.58. Wednesday brought about an oversold bounce, but some key technical hurdles still lie ahead. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index down 31 basis points, trading at 104.01. The September WTI crude oil contract up 41 basis points, trading at 77.91, bouncing from a deeply oversold state. But is it the start of something bigger? We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The September RBOB gasoline up 124 basis points, trading at 244. The December gold contract up 37 basis points, trading at 24.73, rallying back to the top end of its 4-month trade range. Copper up 146 basis points, trading at 417. A relief rally underway, but still deeply entrenched in a distribution cycle. Uranium up 194 basis points, trading to 84.20. The U.S. 10-year Treasury yield down 18 basis points, trading at 405. A considerable breakdown in yields towards its 6-month lows. The key news to watch this week is the non-farm employment change, and next week we have the tail end of corporate earnings and the ISM Services PMI. This week's feature interview guest is Commodity Context founder Rory Johnston to discuss OPEC, shale, crude oil term structure, and the SPR. Eric's interview with Rory Johnston is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Commodity Context founder Rory Johnston. Rory, it's great to get you back on the show. You know, when I saw you on the schedule, I thought I just talked to Rory a couple of weeks ago. It's been months since we've had you on. Now, everything's changed, though. I guess you and I had a completely incorrect understanding of where this whole OPEC thing was going, because it's just been announced by none other than President Trump's campaign that what's going on here is OPEC is working as hard as they possibly can to suppress oil prices because they want to get Kamala Harris elected. I know this is exactly what you've been commenting on in the data that you follow so closely. Maybe not. What's going on here? Is this just politics? And more importantly, what is the real situation with respect to OPEC's intentions here? What is their real intention?
Yeah, so that's exactly right. And I think you and I exchanged briefly on Twitter about this, but the statement from former President Trump was essentially along the lines of what you said, going all out to depress oil prices in order to help elect Democrats and specifically Kamala Harris, because the belief being that Kamala Harris would be somehow better for OPEC. I assume the reference here is to Kamala's 2019 statement that she would ban U.S. fracking, which I don't think will ever happen. But again, I mean, it's an election year. Truth is kind of, and reality is secondary. But I think it's important, and I thank former President Trump for this hook, because I'm writing a piece right now on really kind of disentangling the true extent of how much OPEC is actually supporting the market. And it's important to note that, while we'll get to a second about, the current weakness in the market and what we're seeing. But most forecasters, whether it's the EIA, IEA, OPEC, or a whole bunch of different private sector forecasters, all generally expect that as OPEC extended its production cuts into the third quarter of 2024, that we were going to see a net deficit, a continued strength, at least on a fundamental basis in the oil market from that. But relative to what Trump was saying about going all out to produce and depress the price of oil, OPEC is doing the exact opposite. It's going all out to support the price of oil. Excluding the COVID era cuts, because I think those are a special case, but excluding COVID, the current amount of supply that OPEC is withholding from the market, roughly 4 million barrels a day of realized tangible cuts relative to October 2022 levels when this new cutting cycle restarted again. That's the most crude that OPEC and OPEC Plus is withholding from the market since the 2008-2009 financial crisis. These are crisis level production cuts and market supports at a time when last year demand grew by more than 2 million barrels a day. In any other year, this would be considered a strong year for oil markets. The only difference is that OPEC is supporting us multiple, $10, $20, $30, $40 higher than we were. If OPEC was to completely release the floodgates, open the floodgates and release all this crude to the market, we would probably be sub $50 Brent. That's a lot of oil that's being withheld from the market. And I think while I do not think that OPEC will release that all at once, I think obviously OPEC more than anyone else wants high oil prices. The longer they hold these cuts back, the longer they maintain this crisis level support to the market, the weaker discipline and kind of cohesion across OPEC Plus becomes. And I think that as just a time series, the longer you go on holding these cuts, the higher the probability that the whole agreement breaks down and the ultimate bearish scenario of all this crude coming back to the market comes all at once. But if we're just looking at, a base case, and that's not my base case, I should be very, very clear. If we're looking at a base case, OPEC has said that it's going to start easing the latest tranche, about 2.2 million barrels of oil, 2.2 million barrels a day of production cuts, back into the market beginning in October and extending a year forward into 2025. But if you look at most of the forecasts from the major agencies, IEA, EIA, and OPEC itself, most of those agencies really don't seem to indicate that there's going to be enough room in the market to ease all those production cuts back without tanking the price. Now, Saudi oil minister, Abdulaziz bin Salman, has said that plan is market dependent. And I believe him on this. I think that it's unlikely that OPEC is going to go ahead with a full production cut easing. I think at best they're going to do half and probably even less than that. But I think we're going to need to wait to see where we are come October to see when and how exactly they stick handle the messaging around pushing that back. Because I think it's even more important than the message to the market. It's going to be the message to the membership, because the reason that they had announced that cut easing was that they were trying to placate members, particularly the United Arab Emirates, which has been promised continually that they're going to be allowed to produce more just one day, just around the corner. And so far, we haven't seen that.
Rory, this is a time in history where escalating geopolitical tensions are really the focus of, I think, the most important attention of macro analysts and so forth. Let's take this from another angle. If we get the politics of what was said out of it and come at it from the opposite angle of, we're looking at things like, the whole world is dependent on the Taiwanese semiconductors. Therefore, if China invades Taiwan, it could shut down the global economy. There's a big risk there. Let's talk about what the real risks are. It seems to me that what you're really saying is OPEC has an incredibly large amount of power to foment outcomes, economic outcomes in the West. If they want to, they could do that to advance their own business interests. It's even conceivable, if a real conflict were to develop, that they could use some of their economic power, as a tool of negotiation or as even a tool of retaliation. What is the power? If you were to describe the various, power sources on Earth, how much power does OPEC have and how much influence do they have over the global economy as a result of the fact that they're holding this decision? 4 million barrels, as you say. That, until recently, that was pretty much the entire spare capacity of the world. Now it's just the discretionary amount that OPEC happens to be holding back right now. It seems to me they've got a huge amount of power. And if anything, our politicians should be explaining how much power we've put into the hands of some people that, frankly, our foreign policy is maybe starting to alienate.
The challenge, particularly with forecasting this market, is that not only does OPEC hold, I would say, the dominant power in the oil market right now. I think it's not an overstatement to say that OPEC gets to choose whether or not prices this year and next are at around $80 a barrel or around $50 a barrel. And right now, its decision calculus is that it needs that money. And I wrote a piece a little while ago called OPEC's Price. And this idea that OPEC has historically not explicitly had a price target, and they were actually very wary of that idea for the same reasons that, the Fed doesn't, explicitly state whatever, let's say, S&P target it's looking at or whatever else, that would show its hand and allow front running. But what you can see is that OPEC, through its actions, its revealed preferences, that target price has jumped considerably higher since before COVID. Before COVID, OPEC would really move to support the market if prices were below $60, $50 a barrel. Now, when the latest round of cuts began in late 2022, the price of Brent was sitting around $90 a barrel. This is a much, much higher price level. And overwhelmingly, the reason that I think that this is the case is that OPEC members broadly, but specifically and most importantly, Saudi Arabia has had much larger spending commitments and kind of budget requirements for oil prices. That's their main source of revenue. So they can't really afford these prices going much lower. But the challenge is that the reason that OPEC is not unlimited, it doesn't have unlimited power, is that there are other things that OPEC is competing against, most notably non-OPEC sources of supply, the United States, and, in this case, also Canada, Brazil, Guyana, and a smattering of others that are growing production because of these higher prices. So, Saudis are holding prices at $80, $90 a barrel. That's really attractive and profitable for a whole host of non-OPEC producers. So when they had initially held those prices higher, the belief was that you wouldn't have such strong growth from U.S. shale because everyone knows, quote unquote, that shale has peaked. I've heard this for a decade and we haven't seen it yet. And I think to a degree, policymakers in Riyadh were believing that. But the challenge is that because of this is discretionary, because policymakers are deciding when to like toggle a switch on or off, it's not as easily forecastable. You have to kind of approach it from a scenario perspective. Either they do support prices or they don't support prices, and to what degree. But what you're seeing is that, so far they have continued to support prices. Now, again, the challenge here is that requires political capital within OPEC in order to maintain that discipline. And that, I think, is what generally erodes over time. But really, it comes down to that decision of what price they're going to defend. And, so far they've continued to hold 80. I think that they won't let the price collapse outright. But until we see what that realized price is going to be, I completely agree that Western governments are in this bind where, OPEC is trying to hold these prices higher. You have other discretionary levers in the global oil market, most notably things like the US SPR and the Chinese SPR. But interestingly, and again, going kind of against what former President Trump had said in that tweet, or truth or whatever we want to call it, is that the US SPR has been in buying mode. The Chinese SPR is now going back into buying mode. So virtually every discretionary lever in the global oil market right now is actually trying to support prices higher, not the other way around. The question is, how much does the kind of structural, real fundamental demand picture support higher prices going forward? And on that side, we're seeing increasing signs of weakness creeping in all over the place, most notably in China, where last year, Chinese demand grew by nearly 2 million barrels a day year over year. That's a staggeringly strong demand growth, by my count, larger than any single country's demand growth in the history of the oil market. But now, as of April and May, where we have full data, it looks like Chinese demand is actually not just flatlining, but actually an outright contraction versus last year. Whether or not that can stabilize and turn back up is going to go a huge way towards who is going to be right about the outlook for global demand this year. There's been this long ongoing debate about whether or not the IEA and the EIA, which are expecting around 1 million barrels a day of growth, demand growth this year, or OPEC, which expects 2.25 million barrels a day of demand growth, a huge difference between them. Who's going to be right? And right now, it's looking increasingly like it's more likely to be that 1 million barrel a day of growth and potentially even lower. So we're going to see over this next month, when the new round of forecasts from these agencies come out, how much they lower those forecasts, because I think that's going to be the big question. Global demand, of course, is going to set that final true benchmark and the kind of guardrails around what type of market OPEC is able to ease back into. Because really, while you have non-OPEC supply competition, the primary thing that's going to determine the space OPEC has to ease those cuts is going to be global demand. And right now, that's not especially supportive.
Rory, I am in strong agreement with everything you're saying, except I see a gigantic elephant in the room, or in the case of the oil market, maybe it's a camel in the room. I'm not sure, but something doesn't add up here for me, which is, look, everything you're saying is there's going to be 4 million barrels. OPEC could take that off the market if they wanted to. There's growing pressure for them to do exactly that. President Trump is promising that he's going to persuade them to do that. If OPEC were to just dump that 4 million barrels a day on the market, as you say, we could easily be headed to sub 50 Brent. Furthermore, if you look at other markets, look at Dr. Copper, really down hard below the 200-day moving averages we're recording on Tuesday morning. S&P 500 took a really hard hit on Tuesday morning as well. Boy, really looks like we're headed lower. Maybe we're headed to $40 oil prices, Rory. And you and I understand this because we've been doing it long enough that we both know the thing that we should look for is in the term structure, we should expect a shift into contango. Wait a minute. We're seeing the exact opposite. We've got really steep backwardation, which is the oil market's most reliable signal, in my opinion, that says the exact opposite of everything we've been saying. The forward curve is telling us with this steep backwardation that there is an extreme physical shortage that could take prices much, much higher very soon. How do we reconcile this?
Rewind even 2-3 weeks ago, and I would completely agree that the crude curve was exceptionally backwardated. I think that dovetailed really nicely with those expected Q3 deficits that everyone expected we were going to see. But I was just noting even this morning that, while you've seen that backwardation steadily start to erode, and I think you've actually seen a big sell-off in term structure today. So today we saw crude. We're recording this on Tuesday, July 30th. We saw a big sell-off today in crude again. Crude now, on a Brent basis, sub $79 a barrel. We're getting closer to the lows we saw in early June following the post-OPEC meeting rout. And unlike that period where you actually had some kind of stronger signals, backwardation was, I think, a bit more robust. The physical market signals were a bit more robust despite that flat price fall off. Now you're actually starting to see the opposite. You're actually, versus 2 weeks ago, just before the Brent contract rolls over. When periods like this, I'd like to shift to the spread between the second and third futures months. And backwardation on that basis has fallen from nearly $1 a barrel 2 weeks ago to more like 50 cents a barrel today. So it is still decently backwardated, no doubt. And I think that physically, the market probably still is in some degree of deficit, but that tightness is rapidly easing. If we can lose half the backwardation in 2 weeks, who's to know where we're going to be in 2-3 weeks from now? I think that if that true bearish demand scenario that we were just talking about does kind of continue to linger and persist over into August, I think that we could see oil markets flip back into contango. And if that happens, you're not only going to see kind of obviously, the broader kind of expectations of the market shift, but because of the way that speculators hold their positions on the crude curve, because they want to benefit from that roll yield, you're also going to get additional speculative selling, which is going to push momentum even lower. So I think that's this kind of really bearish down spiral that we could see in oil here if that comes along. Now, I think, like you were saying, the truest indicator in the market is term structure. And that is strong, but much weaker than it was even 2 weeks ago. If the physical expectations, the SD or the supply demand balance in the market does prove to be correct, I expect us to come back into steeper backwardation again. But that's going to be the ultimate tell. And I think, again, if we see in 2 weeks, these markets continue to sell off and those updates from IEA, EIA, and OPEC start to show weaker Q3 pressure, I think that very easily could kind of add to this kind of rolling negative momentum we see in the market. But I don't expect that as my base case, but that's currently where the market is definitely pointing from a risk management perspective.
I want to apologize to any listeners who are not familiar with these concepts for going a little deeper on this, but I think it's really important because I think this signal is so important. Everything you said, I agree with completely, and I was thinking exactly the same thing, which is it seems like what we're seeing is a collapse in backwardation that would suggest that maybe we are beginning that road toward a structural contango in the crude market. But hold on. I've been studying term structure in crude pretty darn closely for a long time. And when that, what we both just said, starts to happen, what you almost always see is that the front month is where the backwardation comes out of the market at first. So you go from a situation where the first 2 or 3 months on the curve have the most backwardation to those are the ones that go into contango first, or they just level off, or they come to a lesser backwardation than the later months out on the curve. We're not seeing any of that. The front month is still the widest backwardation on the curve. That doesn't match the pattern we just talked about.
So far, and I think, again, 2-3 weeks ago, that was even more true, that when you've seen this crude sell-off for the past 2 weeks, it has been disproportionately felt along the front of the curve. Right now, I think, and anyone that follows the Brent market, and again, apologies for going kind of deeper and wonky here, is because of the way that the Brent market settles, that prompt contract spread or the prompt calendar spread is especially unreliable as a signal. It gets very spiky right around expiry, which is why I shift to that 2nd to 3rd month spread, which is, in my humble opinion, a kind of more stable, slower moving, and I think less prone to false signals. But I definitely agree. And I would say that even if you look at it, it trends very closely with the prompt spread in all but those expiry periods. And on that basis, again, it's weakening. So I think while still backwardated, if we didn't have any other data in the market, I would say, yes, we are still in a supply deficit market, but that supply deficit is weakening. And, as everyone always says, the market looks ahead. So if let's say demand, based on my data, and again, I'm going back to the other fundamental data now, supply growth is maintaining relatively firm, whereas demand growth is weakening very quickly. So if we continue that trend forward, it's very easy to see how we end up into an oversupplied market, which would then justify contango conditions. Now, again, we're going to need to see where we come over the next couple of weeks here. I think it's going to be a very important couple of weeks because I think most notably, this question of, is China going to remain in effective contraction? In 2022, when really more than anything else, the two big things that derailed the oil market rally in 2022 were, one, we didn't see the supply collapse in Russian production that everyone was expecting. And two, I think even a larger physical loss to the market was Beijing embarked, along its extremely draconian COVID-0 production cuts. During that period, that was the first annual contraction we've seen in Chinese oil demand in decades. I think it's something like 30 years, depending on the data you're using. Right now, if Chinese demand stays roughly around May, June levels through the rest of the year, because of how strong Chinese demand was in the second half of last year, that base effect is such a huge hurdle to clear. If we stay flat right now for Chinese demand, we will effectively be in another year of very modest, but still contraction. That is a very, very not great signal. I think what's really interesting here is, because we can look at Chinese demand for a couple of different reasons. Obviously, I look at it primarily for the oil kind of implications, where is supply and demand in the oil market going? But a lot of other people kind of look at it in terms of a macro signal, what's happening with the Chinese industrial economy, et cetera, et cetera. And when you look at that, there's a lot of concern that the primary area of weakness in China right now is in diesel, which is the part of the barrel that's most closely connected to the industrial economy. But I think here, there's actually a really interesting nuance to point out. And while everyone has been talking about how we should be expecting any day now global gasoline demand to really start to feel the brunt and the kind of contractionary pressure of rising EV sales, particularly in China, gasoline and jet fuel are the consumer-driven fuels are actually the only real bright spots in Chinese oil demand right now. So it's not EVs that's driving that. But what we are seeing on the diesel side is increasing stories and increasing evidence of actual LNG or natural gas displacement in long-haul trucking. which is fascinating because even a couple of years ago, we wouldn't have expected LNG to be that much cheaper. But because of the rout and the kind of weakness in global LNG pricing as well, you've seen this really strong cost competitive drive for Chinese long-haul truckers to shift their fleets into this LNG or compressed natural gas drivetrain system. And it's really hard to get really granular estimates of this in China because it's very opaque. But it's somewhere between 300 and 600,000 barrels a day of demand destruction or demand displacement from that specifically. And what's fascinating is we actually see this similar in many ways in the United States, not from LNG displacement, but from renewable diesel displacement. So diesel is this market that I myself have said for years would be one of the longer term, more robust areas of the oil market, because even though gasoline demand was going to start getting eroded by EV sales, you weren't going to see the same pressures in diesel because you can't electrify long haul trucking in the same way. The economics and the physics just don't work that way. But when we're seeing direct one-for-one displacement with renewable diesel in the States and LNG and trucking in China, well, all of a sudden that argument starts to break down. And I'm starting to get very worried around diesel as an actual engine of growth going forward. We're going to see where how far this can go. And I think there are a lot of very reasonable criticisms of the economics of renewable diesel in the United States and whether or not it can really stand up on its own. But China is not subsidizing LNG in the same way that the United States is subsidizing renewable diesel. And that's continuing to drive that out. So I think that even beyond the broader macro weakness in the Chinese economy, you're also having idiosyncratic weakness in the diesel structure in China driven by this displacement.
Rory, I want to go back to what you said about shale and whether it's peaked, because a lot of smart people have persuaded me that, look, if you're considering where this market is headed and the OPEC cuts and all that stuff, you don't really need to worry about that in the long term. In the short term, it's very important, but in the long term, this is really clear. What's happening is shale has much steeper decline profiles than conventional oil. We've pretty much tapped out shale. It's almost done. It's almost over. The shale revolution is pretty much peaked out. It's almost done. And as soon as that goes into decline, look out, baby, because that's when the global energy crisis that cannot be solved begins. Boy, that sounds really persuasive. Except that what keeps happening is the U.S. shale industry keeps on kicking ass and keeps on breaking every record. They do seem to be hitting a plateau here, at least in the weekly data, but you've said before the weekly data is not the best place to analyze that. So what do we make of this? A lot of smart people are really convinced that shale can't have much longer before it not only peaks, but it goes into a necessarily irreversible decline that cannot be prevented. It hasn't happened yet.
Basically, I've been actively working in this market for about 12 years, and I've heard that shale has peaked in almost every one of those years. And so at the very least, U.S. shale production and broadly kind of U.S. tight oil production has exceeded expectations every year I've been working in this market. At this stage, I think if you have a given forecast for U.S. production, I think your handicap should always just be it's probably going to be slightly higher. And everything, obviously, but COVID, and that was obviously because prices went negative, and that's obviously going to have a pinch effect. What you saw, I mean, everyone's pointing right now, and I think reasonably, I mean, it makes sense to be wary about continued or particularly accelerating growth from U.S. shale when you see a peak and a pullback in the U.S. oil-directed rig count. This is obviously the number of rigs in the field drilling new wells. That you need to keep that going because, as you noted, shale is a treadmill. It's a very steep treadmill, so you need to keep that going. It gets harder and harder to keep up. But if we looked at the U.S. rig count alone and said that will be the fate for the U.S. oil production trajectory this year, then last year you actually saw rig counts peak at the end of around 2022 and fell through most of 2023. So, well, that year we absolutely saw U.S. shale decline, right? Actually, not only did it not decline, but it doubled the initial expectations of growth. The EIA initially was expecting somewhere around the ballpark of 600,000-700,000 barrels a day of U.S. total liquids production, and it ended up being closer to 1.5 million barrels a day. That's a lot of production. And I think, again, when you look at, I would go back to OPEC for a second. I think OPEC was banking on the United States not just not just having that 700,000 barrels a day of growth, but probably underperforming because they were very hopeful. But when they so thoroughly overperformed or outperformed that expectation, and then you also had the add-on of about 700,000 barrels a day of additional Iranian supply, well, all of a sudden, they lost all of their expected room to ease these production cuts. If you remember, when Saudi Arabia initially agreed to its so-called 1 million barrel a day lollipop cut in the summer of 2023, that was initially supposed to be a very temporary production cut. So temporary, in fact, that they were going to announce its fate on a month-by-month basis. Now it just got rolled over and rolled over and rolled over because expectations of U.S. supply decline or plateau just never materialized. What you saw was that you saw increased efficiency across a whole bunch of metrics. Those rigs were drilling, you had fewer of them, but they were drilling more productive wells and they were drilling them faster. So you're getting a lot more bang for your buck. That's still going to happen now. And I think the rig count always needs to be adjusted by whatever other productivity metric you are. So people are going to get really angry at me and say, oh, well, sure, they're drilling longer wells, so your production per foot is declining. But I don't personally care that much about production per foot because if you're drilling longer wells, it really kind of swamps it out. What I care about, particularly when everyone's looking at the rig count, is what your effective kind of per well productivity is. And that generally has maintained and kind of supported higher production. I don't think, and I should say, everyone expects, and then this is, the IEA, OPEC, EIA, all expect U.S. shale production to slow this year relative to last year, notably, and to continue to slow into next year. But I think that is going to be largely dependent on prices. If prices are higher, then I think that growth will reaccelerate because this is the U.S. shale producers are the shortest cycle, most price sensitive supply source in this market, and they're going to follow prices higher. Because I think the other thing is here, in some ways, a collapse in OPEC production cohesion and the kind of collapse of the deal and a 4 million barrels a day of oil back on the market, that's very bearish, obviously. But what it would also do, it's also really bearish for U.S. shale production because U.S. shale producers are not going to likely break even at $50 a barrel Brent. So if you want U.S. producers to retrench, you're going to need lower prices because they're still making money at this stage. They're making less money now than they were at $90 or $100 Brent, but they're still making enough money to grow. So I think the challenge for OPEC, and this is why it always, even a monopolist or a cartel in this case, needs to be conscious of other sources of productive competition and what it's doing to demand. So if you get lower prices, one, that's going to help demand growth, particularly in emerging markets, and two, it's going to help pull back U.S. shale supply. The other sources of non-OPEC production growth, Canada, Guyana, and Brazil, are generally going to be longer cycle and less price sensitive, at least in the short term, than U.S. shale is. But if you pulled back, let's say if that bearish scenario happened, you got 4 million barrels a day of OPEC crude back in the market, prices sunk to $45 a barrel Brent, I would expect at those prices that we would see not just a plateau, but a contraction in U.S. shale production. But I don't think it's likely going to happen, at least in the immediate term, with prices at $80 to $90 Brent.
As you alluded, Rory, the other big player besides U.S. shale is obviously Saudi Arabia. And I'm going to make the argument that with everything going on in the world, Saudi Arabia is both a very important geopolitical player right now because they're seeking to stabilize and prevent a runaway situation with geopolitics in the Middle East. And they're also a very important and powerful player in the oil market, as they've always been. Now, most lay people who don't work in the oil market, you think Saudi Arabia, you think MBS, Mohammed bin Salman, the crown prince and head of state of Saudi Arabia. I would argue, and I'm pretty sure you're going to agree with me, that for the purposes of the oil market, the person who's even more important to pay attention to is the one you mentioned earlier, Prince Abdulaziz bin Salman, call sign ABS. That's MBS's older brother. He replaced Khalid al-Falih as the oil minister. Now, I've had a very strong impression ever since he took that position. First of all, when he took over, I got a very, very strong impression. This is an extremely confident man with a plan who knows exactly where he's headed in this new role. And frankly, that didn't add up because what was going on in the market at the time was all kinds of crazy things. And it just, I didn't understand why he seemed so confident. But as I've watched this evolve over the last couple of years, Rory, what I keep getting the sense of, and I can't really pinpoint or put my finger on why I think this, but I think that ABS has a different job than his predecessor, Khaled Al-Falih. I get the impression that Khaled Al-Falih's job was the obvious one. We're in the oil business. We need to have representation on OPEC. It's the most important job in the whole country. We're giving it to you, Khaled Al-Falih. Do a good job. I don't think that's ABS's job. I think that his job is to be the oil guy as part of a much larger plan to transition the kingdom's wealth management strategy to diversify out of the oil business, try to get into as many other oil businesses and invest in other places around the world. And although on paper it looks like supposedly ABS is just the oil guy and all he does is focus on the oil market, I have a very strong feeling that he is one of the key decision makers in a much bigger process and that there's a bigger plan for Saudi Arabia that they're not telling us. Am I crazy to think those things? Do you have any of those impressions? And what do you think ABS is up to and why he seems to be so confident and so certain of the direction he's taking this?
I think you're dead on. The one thing I'll say, so a couple things about ABS, and we'll say MBS and ABS to just, really make this speedier. ABS is also, interestingly, the first royal to hold the position of energy minister. Historically, it has been someone that has been much more of a civilian technocrat, more associated with Aramco, where you have had far more independence for Aramco and oil policy in Saudi Arabia outside of the direct control, or at least the day-to-day control of the royal court. And I think what you've seen in this case is that, absolutely, I think that what, as I understand it, what it appears to be is that MBS has a lot of huge spending priorities through Vision 2030. It's all being funneled through the Public Investment Fund, or the PIF, one of the main Saudi sovereign wealth funds. They're spending huge amounts of money. Bloomberg had a really interesting analysis recently that factored in PIF spending and kind of calculated the so-called fiscal break-even price for oil for Saudi Arabia is something like $105, or it's above $100 a barrel. That's really, really high. And obviously they need these prices higher in order to kind of maintain the spending and to not have to issue a bunch of debt. They're also doing things like selling off additional pieces of Aramco to the public market. But I definitely think that ABS's marching orders have been to keep prices higher. So I actually did, in grad school, one of my major research papers was on Saudi oil policy, the equivalent of a thesis at the time. And what you look at is that the history of Saudi oil policy is very technocratic and very generally like small c conservative. It was very consensus based. You had a lot of very slow moving pieces. There wasn't a lot of volatility in the policy. They were the price dove within OPEC. They wanted, relative to all the members like Iraq and Libya that wanted higher prices and revenue right now to kind of fund their various budget issues. Saudi Arabia had a much longer term perspective on this market. They wanted lower prices to help support the global economy, to help, or at least not to help accelerate the development of alternatives like electric vehicles, et cetera, et cetera. So they wanted to be in the long game. What's interesting is when MBS initially came onto the stage, and there was all this talk. It's hard to remember almost a decade ago when that everyone kind of viewed MBS as this broad liberal kind of revolutionary in many ways within the Saudi establishment. Obviously, that's changed considerably years on. But I think in many ways, one, he is still liberalizing a bunch of Saudi society, and two, the worry at the time was that, well, if he wanted to move Saudi Arabia past oil, then, well, why wouldn't he just open the taps? Because if the view is that Saudi Arabia has these massively large oil fields, and no one knows exactly how much is left in them, but I think likely a lot of oil, particularly, potentially more oil that can ever be produced relative to global climate ambitions and everything else. Well, the view was, well, why not produce everything right now, monetize those reserves, and then use that money to invest in things like real estate and tourism and high tech and everything else. That was the initial concern. There was a worry that MBS was going to be really bearish for the oil market because he wanted to basically push everyone out and maintain their position for as long as possible. What you've seen in reality seems to have almost been the opposite, that they have huge spending priorities, but now they're cutting. Saudi Arabia itself is withholding around 2 million barrels a day of crude from the market. That's on top of likely what they claim to be another 1 million barrels a day of spare capacity on top of that. So the delta between what they are currently producing and what they say they can produce is actually 3 million barrels a day. Now, I usually forget that last million because everyone gets very conspiratorial about it and what they can really produce, et cetera. I don't think it's a hugely productive conversation, but we know that they were producing 11 million barrels a day at the end of 2022, and now they're producing 9. So there's a huge amount of, that's a huge amount of very valuable production. That's like $50 billion, $60 billion almost of equivalent annual revenue at current prices. That's a lot of oil. So the question is, the challenge for them is the further they cut, the harder it is, because every time they cut production, that also increases the fiscal break-even price, because it's not just prices that matter, it's prices times volume. So the more they cut, the higher prices they need, which is why I don't think that they can justify cutting much more for much longer in order to kind of prop those prices even higher. So this question is, how can they maintain this? And I think the big risk here is if you see, let's say, another massive upside surprise. Let's say U.S. shale production, again, shockingly, surprises to the upside in the second half of the year. Well, all of a sudden, then maybe MBS and ABS start thinking, well, maybe we can't hold prices this high because it's just essentially subsidizing non-OPEC supply. And that's where the real worry begins. Now, again, I think that the challenge here for the Saudis is they need these high prices right now. But I do think that the larger kind of go forward concern, as you were noting about diversification, et cetera, is why are they going to withhold production and hold prices high if they really want to monetize those reserves? I think that is still this kind of big lingering question in the market of what they're going to do. And at this stage, maybe they don't believe that global climate ambitions will be anywhere near achieved, and maybe they can maintain these prices for higher for longer, et cetera, et cetera. But the longer this goes on and the longer they're fighting against this very challenging tide of both slowing demand growth and stronger non-OPEC supply, the harder that is to justify.
Rory, I think we're in agreement. ABS, I'm convinced, is in charge of a whole lot more than just the oil market. And frankly, I don't think the kingdom wants the rest of the world to understand how much he's in charge of or what the real plan is. I think it's secret. In any case, time will tell on that one. I want to hit Russia next. Look, what's going on right now is a whole lot of very significant escalation. We don't know where it's headed, but I think we do have to talk about that other big hot potato in the room, which is, what if we got to escalation where we've got tactical nuclear exchanges and we really are moving into direct military conflict between the West and Russia? Russia is still, behind the U.S. and Saudi Arabia, one of the biggest producers in the world. We just talked about how the 4 million barrels that OPEC is holding back could have a profound effect on the market. If Russia got taken offline, that's 8 million barrels. So what would the impact be of an outright war with Russia on the oil market?
It would obviously be huge. And I think this is, the oil market right now, and as we've kind of discussed through various points here, it's really hard to have just a steady, really high, let's say at a high conviction base case, because all of these big tail risks are there's no real black swans. There's just a ton of white swans kind of floating around that we know could come to the market at any particular point, but it's hard to put them in any particular base case. So yes, back in early 2022, a big part of the reason that prices spiked to $130, almost $140 a barrel Brent was that there was, the IEA, I think it was in their April 2022 oil market report, said that there was the risk, and they expected that Russia was going to lose 3 million barrels a day of production. That's a lot of oil. That alone is almost the equivalent of what I'm talking about that OPEC is currently withholding from the market right now in total. That would have been at the time hugely bullish for prices, and I think possibly would have pushed us not just to 150, but maybe even to $200 a barrel if it was realized. Now, I think the challenge is that there's two things I think we need to consider here. One, we've already diversified a lot of the Russian flow away from the West. So it's going to China now, it's going to India, it's going to Turkey. A lot of these areas that are absorbing Russian crude are not necessarily going to be as sensitive in a heightened geopolitical conflict. The other challenge here is I would say, very frankly, it's impossible to know what call it a broader accentuation of this conflict. If we actually had an exchange of tactical nuclear weapons, it's hard to think that the broader global economy wouldn't suffer, which would then take demand down with it. Now, but if you lost, let's say just, hyperbolically, that the combination of Ukraine and Washington decided to really try and neuter Russia. And obviously, Ukraine has been going after Russian refineries. Let's say they go after a bunch of pipelines and they bring Russian production down, by 50% or more. then yeah, that's good. Then we could be we could easily be testing very, very, very high prices again. Now, I think part of that is that now we actually have a huge amount, unlike in 2022, when again, one of the big bullish talking points at the time was that OPEC itself was struggling to keep up with its planned production increases as you were easing back from those COVID era cuts. So there was a big question of like, does OPEC have any spare capacity left? Oh my goodness, now we're going to lose 3 million barrels a day of Russian crude. That's how you could easily have gotten above $200 a barrel. Now, if you lost, let's say 3 million barrels a day, well, the rest of OPEC, at least that first tranche of losses, could probably accommodate for. But more than that, and yeah, I mean, I think that it's hard for people, because people think 3 million barrels a day, okay, 3% of the market. That's not a huge amount. But in the most exceptional periods, in bullish and bearish periods in the market, you're not talking about 3 million barrels a day delta. You're talking about 1 million barrels a day of difference in either direction for a prolonged period of time. It doesn't take a lot at the margin to push this market into a bull cycle or a bear cycle, with the exception of obviously COVID, where you had like 9 million barrels a day of supply surplus in early 2020. But I think that's absolutely. A true loss of Russian production would be hugely bullish. I think the big question, though, is one, how much would demand suffer in that scenario as well? I think that's the biggest challenge to really know firmly.
Longtime listeners already know my final question, because it wouldn't be a Rory Johnston interview without a discussion of the good, the bad, and the SPR, the Strategic Petroleum Reserve of the United States. I could ask you 24 questions on the SPR, Rory, because you've done so much good work on it. In the interest of time, I'm going to leave it to you to just pull together, what do we need to know about the SPR? What's the update?
Yeah, so essentially what we've seen, the latest news was that the U.S. DOE completed its most recent purchase of crude for the U.S. SPR of roughly 4.65 million barrels of U.S.-produced sour crude. That's what they've been buying for the SPR. That brings the total to date to around 43.25 million barrels to date. And I should say that's the total that they have refilled as part of this refill effort. Now, that's a hefty sum. But I think detractors, will reasonably say, well, 43 million barrels is a lot, but it pales in comparison to the 200 plus million barrels that the Biden administration released as part of its emergency releases between the end of 2021 and the beginning of 2023, which is absolutely true. The challenge, however, with this is that the DOE and the Biden administration doesn't actually have much money left. But where did it all go? Because obviously they sold all this oil. The challenge is that, and I think we've discussed this before, that Congress had mandated a bunch of sales of crude from the SPR essentially to paper over budget holes. They saw the SPR as a gigantic crude piggy bank. And part of what the Biden administration negotiated at the time, and I think it was actually a really good thing to have done, was when they sold all of that oil, they exchanged the cash or most of the cash that they got from that sale. They basically made a trade with Congress. They said, you can have the money if you cancel these mandated sales going forward, because otherwise you would have had another 143 million barrels of mandated sales that would have occurred between fiscal 2024 and fiscal 2027. So that would have brought us even lower, and I think everyone would have said, oh my goodness, the SPR is so low. So they traded that. The challenge is that now, based on a news with an interview with Deputy Energy Secretary David Turk, who spoke with Bloomberg News earlier this week, he revealed that there's roughly $1.2 billion remaining in the SPR's petroleum account. And that's the accounting entity, essentially, the line item that the DOE can use to purchase oil for the SPR. That's where all the money went from the sale. And that's essentially how much they have left. So $1.2 billion. It's a lot of money, but it's roughly only enough for about 15 million barrels of additional purchases. So now the question becomes, if people want the Biden administration to continue refilling the SPR, they're going to need to recapitalize that petroleum account. They need to put a huge amount of money in there to keep refilling. And I think, as we've discussed before as well, I see value in empty space in the SPR. I think that, let's say we have that scenario where OPEC completely opens the floodgates and the market crashes to below $50 a barrel, and we end up in super contango when there are hedge funds chartering tankers for floating storage plays and everything else. That's the kind of environment where I think the SPR should be buying hand over fist, because not only are they getting a great deal, but they're supporting market stability in the process. They're essentially helping close that oversupplied arbitrage opportunity. But to do that, they need money to buy oil. And I think even if we recapitalize the account today and you don't use it. I think it's valuable to have that money sitting there, because otherwise, let's say that happens in 2 months from now, let's say. Well, and we haven't recapitalized the account already. Well, then you need to go in this huge political debate around give us the money. Oh, well, we'll think about it. Weeks pass, and you miss the opportunity to support the market at its greatest moment of need and to get the greatest deal for US taxpayers. So I think that it is good policy now to plan for the future and to recapitalize the SPR so that it can purchase more crude if market conditions warrant. And I think that's this next debate. And you actually have seen that the Biden administration has now requested more money from Congress to do this. But obviously, this is an election year, and who knows? It's very unlikely that Congress is going to voluntarily hand up gobs, billions and billions of dollars of new money to the Biden administration for them to continue doing what at least the Biden administration considers to be a win for them, that they released a bunch of oil, but now they fulfilled their promise and they've continued to refill it. But they can only refill, like I was saying, about another 15 million barrels, and then they're out of cash. So we can only really have roughly 3 more of the purchases of this size before there's nowhere else to go. And I think that's the big challenge going forward, is if we want the SPR to be more active, if we want the SPR to be more resilient to these market conditions, then we're going to need to fund it properly.
Rory, I really enjoy our conversations. You've got one of the most refreshing and thoughtful views in energy markets, and I guess that's no surprise since that's what you do for a living at Commodity Context. Before we close, tell our listeners a little bit more about that. What services are on offer? Is it institutional only, or do you have a retail product as well? Who's it for? How do they find out more? And for people who are not subscribers to your work, how do they follow you just on social media and elsewhere in order to keep ahead of what you're up to?
Thank you for having me on, Eric. And I always enjoy these conversations immensely as well. People can follow all of my research at the moment at commoditycontext.com. I publish on Substack a variety of thematic topics. I usually publish roughly twice a week on a variety of thematic topics. I have what I call data decks, which are big kind of data dumps and PDF packages of major things that I track in the market. And then every week on Friday, I have what I call Oil Context Weekly, which is my weekly wrap up of all the big important things that happened in that week. You can also follow me on Twitter at Rory_Johnston. And in terms of an institutional package, I have begun building out, and I should over the next couple of months have a product ready for institutions that are looking for higher touch coverage, much deeper on some of the things that we've talked about in this podcast and things that I write about at Commodity Context, as well as a data package. A lot of the data that I've cleaned and the data that supports my analysis in this work. And I'm now looking at working with different corporates to help advise them on how best to navigate these really kind of choppy and treacherous waters. And again, an ever unprecedented oil market.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rory back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Rory's picture saying looking for the downloads. As always, Eric, let's start with the crude oil chart and the EIA inventory.
EIA printed a drawdown of 3.4 million barrels of crude oil, Cushing, Oklahoma drawing down 1.1 million barrels, gasoline drawing down 3.7 million barrels. Distillates was the lone build on the board, building 1.5 million barrels. U.S. production holding steady at 13.3 million barrels. That is the plateau that we've seen for quite a few weeks now. The chart was looking awful, breaking down and closing well below its 200-day moving average. Looked like it might be headed back into the 60s, but hey, a little war here and there will change things pretty darn quickly in the crude oil market. So needless to say, this big recovery that we've seen in the last day or two has been driven by geopolitical escalation. Where the market goes from here will depend on the news flow, but my view here, and I admit that I've been wrong, or certainly early in the past, past is I really think that this Israel-Gaza conflict has the potential to get a whole lot bigger from here. If we really get into outright war, U.S. defends Israel against Iran. Eventually, U.S. is striking Iran. Iran is striking U.S. Potentially, that would pull Russia as Iran's ally into a position of directly facing the U.S. And yes, I'll say the bold thing. I don't think it's at all out of the question that this eventually escalates either in the Gaza theater or into the Russia-Ukraine theater into at least a tactical nuclear weapon being detonated. And that would be a really big deal. How it would affect markets and how it would affect, for among other things, the uranium market is anyone's guess. But I really do think that we're facing a pretty bad situation here.
Yeah, certainly the geopolitical escalation fueled that, as well as inventory numbers, creating a little bit of a bounce in crude oil. But on page 2, I have that chart. And what I wanted to highlight was that there's this very large pennant that has been forming for close to a year. And when you take the highs and the lows of that fourth quarter of last year, $80 is the midpoint. And we're pretty much trading right into the $80 level. It really just shows how tightly wound up the oil market has been in this massive range. And while we identify these short-term bullish and bearish impulses over several weeks, this really has been winding up for what could inevitably be a very big move, but we're right in the dead center of that range, and the market hasn't shown its hand. This is an area where the oil markets are very neutral and could be range bound, like the interview was suggesting for at least some of the short term. But what I find particularly interesting is in the sector rotation in the whole market, the energy stocks have actually surprisingly been doing pretty well, considering oil's been weak over the last several weeks. Oil's energy names anyway have been working their way higher, and it'll be interesting to see whether the energy stocks can march to the beat of their own drum, or whether they're going to be pinned to oil from this point moving forward. Nonetheless, I want to move on to the S&P 500 and get Nick involved in this conversation. Nick, let's start off just with the S&P. What are the technical levels you're watching?
Yeah, Patrick. So right now, spot price on SPX is approximately 55.20. We have an implied move for the August 16th monthly OPEX of plus minus 130 points. Therefore, the upper implied move is 56.50 and the lower implied move is 53.90. Right now, we have key resistance at all-time highs at 56.70 and key support just below at 5,500. I'm inclined to think we see a move a bit higher right now until we test out that perhaps all-time high level. I do still think we tag that 5,300 mark before the end of September or so.
Well, what's interesting here, Nick, is that the rally that happened on Wednesday was not spurred by the FOMC. It actually almost was over by the time the FOMC meeting was on there, and it certainly wasn't triggered by Microsoft's earnings. It was some form of a short squeeze from what the S&P was a very oversold market here. Essentially, that 300-point drop throughout July has spurred this reactionary bounce. Often during corrections and bear markets, the rallies are very intense and sharp, and this is why I want to initially be a little bit skeptical. This 5,600 area on the S&P futures, I have the 4-hour chart here on page 3, is the 61.8 retrace area of the sell-off. And if this market in any way fails to beat 5,600 on the upside and follow through, that leaves the window actually on the very short term for this to break down. The downside target would be down to about 5,300, leaving the window open for about a 300-point drop. Clearly, we have some big things coming out. We still don't know the earnings from Apple and Amazon, and we have the jobs numbers coming out on Friday, all which offer the catalyst for potentially either a breakout above 5,600 and or a failure at this point. And so it's interesting that we're trading right at this key pivot, and I think the news is going to decide it. If it does, 300 points of downside toward 5,300 is definitely the logical downside target. I want to move on to talk talk about the Russell on page 4. And I know that you've been bullish the Russell, and well, it is a bullish chart, right? It's been holding up along its highs. It hasn't really corrected during the period when the S&P was correcting on the downside. The one thing in my mind, though, is that I think that at this stage, the Russell could still potentially outperform the NASDAQ in some form of a further rotation. But whether the Russell has the gas in the tank to punch 2,400 on the upside for the next impulse will have a lot to do with whether both the NASDAQ and the S&P continue to rise and beat their key technical levels. I think there will be correlation in all these indices, but it's possible in my mind that Russell outperforms. Well, is that still your conviction here, Nick?
Yeah, I'm still thinking we see all-time highs on the Russell over the next couple of months. Again, outperformance over tech right now is what I'm looking at. I was kind of pair trading the small caps long and with large caps short, and thus far that's been a pretty good trade overall. Butterfly spreads have been really, really nice about a month out when trading these names. Like, for example, if you take a butterfly spread with a middle strike at the all-time highs on the Russell, you get pretty good asymmetry of risk overall. And the opposite effect with the Qs, from the all-time highs, taking, a 20 point out of the money butterfly put spread. I had one a couple of weeks ago and it went from $1.60 or so to $6. And that was a pretty nice move overall. A nice little hedge, so to speak, in the markets right now. So.
Well, let's move on to the NASDAQ. Clearly, a very big up day on Wednesday, but it still is only like at its 38% retracement of that decline and trading pretty much right at its 50-day moving average. What are the levels you're watching on the Qs?
So right now, spot price on Qs is approximately 473, and we have an implied move for the August 16th monthly OPEX of plus minus 13 points. Therefore, the upper implied move is 486, and the lower implied move is 460, right at that support area. Right now, we have Q resistance at all-time highs at 504, and I'm inclined to think we see perhaps a bit of stagnation in the Qs. But again, with Apple and Amazon reporting, it's anyone's guess. If Apple and Amazon outperform, it's possible we're back at all-time highs in the next couple of weeks, or it's possible we're back at lows again within the next couple of days.
All right, well, let's move on to the volatility index. And what we continue to see is elevated levels of volatility. I mean, we spent pretty much almost the entire year pinned in the 12 to 15 vol handle range beyond just a quick little April pop above. And here we are consolidating well above that 15 handle. And it continues to imply some wider ranges in the market and certainly is not yet signaling that some new bull market has begun, which usually sees this vol massively retrace. What are the vol levels telling you, and what are you thinking?
So right now with the VIX at a 16 handle or so, we can expect to see top to bottom intraday moves of about 1% on SPX. Insurance isn't as pricey as it was last week, but it is still more expensive than it was a couple of weeks ago. That being said, with the election coming up in a couple of months, I think it's important to look at hedging portfolios that are heavily correlated to the S&P 500 and using, butterfly put spreads, for example, that are very, very wide and out of the money, or put spreads is a very good way to capture some of that downside risk without expending a lot of premium overall.
All right. Well, I want to move on to the US dollar, which actually continues to be quite range bound. So I wanted to focus specifically on the US dollar yen. Clearly, a hawkish Bank of Japan came out trying to defend the yen. And what a move it's been with that US dollar yen moving over 1,000 pips in just a few weeks. And really a potential trend shift. We're right now approaching a trend line that is just connecting all the previous lows and a Fibonacci zone. This is obviously a place where some very oversold short-term price action could result in just a reactionary bounce. But the bigger question is that even if we did see a bounce back to 152 or 155, is that simply just it retracing a little bit before resuming what is potentially a new established trend? The yen has been in a 3-year bear market, and if some catalyst like this has turned the trend, this could be a bigger long-term trade that really establishes a new trend. And it's interesting because the currency markets generally have been very pinned and there hasn't been a lot of action. And so the fact that we can have a big move in a currency like this is waking up the Forex markets.
Now moving on to page 8, we have that gold chart. What are your thoughts here, guys?
The front month futures price appears to be up huge this week, way over $100 up from last week's podcast. But actually, more than $50 of that big move is actually just the roll premium, or what some people call the contango yield capture on the August to December contract roll. Tape indications clearly say that this correction is over and that we're headed back toward new all-time highs. But clearly, the Israel-Iran-Hamas escalation this week has been a big driver of this reversal. So I suppose in theory it's still plausible, although I would say very unlikely, that the market could still grind lower if the geopolitical situation abates abruptly. Now, exactly how the situation would abate abruptly, given what looks to me like a extreme and rapidly escalating conflict between Iran and Israel with U.S. participation, how that blows over, it beats me. But I think that's what it would take to get us back down to the June lows on gold. But there's no reason to expect that to happen.
Well, certainly precious metals have had some volatility here on the short term, but when you really step back here, Eric, and look at this gold chart, it still has all of the bullish characteristics technically. It's holding above its moving averages. The pattern of higher highs and higher lows is persistent. And certainly with the fact that gold has worked its way right back towards its July high is an indication that the buying pressure is still there. This is a chart that could potentially still break out. If we gain any upside momentum at new highs, 2,700 is the measured targets on the upside. So watching closely here whether or not the bulls can follow through is going to be an opportunity for a potential new bull trend.
Moving on to page 9. Eric, what's the update on uranium?
Our good friend Justin Hune over at uraniuminsider.com heard my commentary in last week's podcast and reached out to me. That led to an exchange of several emails. Justin's view is actually a little bit closer to my own than I realized. Justin sees uranium and uranium miners as a screaming buy here by any reasonable fundamental and technical analysis of the uranium market by itself. Now, from a seasonality and fundamental driver perspective, the upcoming World Nuclear Association conference in London in September, which both Justin and I will be attending, by the way, has in the past often been a bullish catalyst. Similarly, last year, the market was flat to down for more than half the year. Everybody was saying exactly what we're saying now. Boy, is this thing over? Is it done? It must be all over. Then the big rally started on August 18th of 2023 and carried the URNM ETF more than 50% higher in the next 6 months. While many of the stocks on Uranium Insider's focus list performed even better than that. So the argument that last week may have marked the bottom of this market is quite strong. And I definitely want to credit Justin, not just for calling it after the fact like everybody else does, but Justin's been telling us subscribers, I think the market's about to bottom. It's coming. He's been saying that for the last couple of weeks. Last week he said, I think it's this week. Now he's saying he thinks it's probably behind us. I think he's probably got it right. Looks to me like we may have put in a bottom there, but this sector is famously volatile and has massive retail participation. And Justin agreed with me that if we saw a broad market risk-off event, that could easily lead to an even bigger sell-off in the uranium miners. Not because it makes any sense, but just because we got so many retail guys that are just wound up with leverage and margin and so forth. If they're forced to unwind, it's going to get ugly and it's going to happen quickly. Now, beyond a broad market sell-off, the only catalyst I can think of to drive uranium and uranium miners substantively lower from here would be another nuclear power plant accident like 3 Mile Island or Fukushima. Now, if you're worried about containing the risk of a broad market sell-off, the safety trade, I think, there is out of mining shares and into SPUT, the actual physical uranium. I don't think SPUT would go down on a percentage basis nearly as much as the more speculative shares. But that also means missing out on the greater upside potential of the mining shares if it turns out that last week really was the low on this correction, or the bottom of this correction, I should say. The other risk to consider is that it's entirely plausible that the present geopolitical escalation leads to the detonation of a tactical nuclear weapon. Now, that's never happened before, so we have no historical precedent to refer to. But my opinion is that any nuclear weapon detonation is likely to lead to renewed and substantial public skepticism of nuclear energy. Now, that makes absolutely no logical sense. It's irrational, it's unjustified, and nonsensical. But that's what tends to happen in the nuclear industry when you have some kind of safety event. And certainly a nuclear warhead, even though it really doesn't have much to do with nuclear energy, would probably get the public freaked out about anything that has nuclear in its name.
Yeah, Eric, I don't see any reason why the bigger uranium bull market is over. This entire pullback has been like a half a year consolidation and certainly created some short-term volatility. But this will probably all prevail as a big buy on dip. The big question, of course, is where is the change in trend? Now, we had the spot prices of uranium upticking today. It's been weeks since we saw an uptick on spot prices. And so there is certainly some indications of turning, but it's incredibly premature. I'll be looking for that Sprott Physical Trust to be clearing its June and July highs before we can really start to say that the price action is starting to show accumulation and a shift in trend. So a lot of work for the bulls up ahead. The last thing I wanted to touch on is the 10-year Treasury yield. And what's interesting is while we haven't made it all the way back to the December last year and January lows on yields, we're basically near 5-6 month lows, and certainly looks like the yields are heading down there. Bonds have been a great safe haven during this correction, and certainly now that the central bank has indicated lower rates, money flow into Treasury is happening. It's happening right across the board at all levels of duration, and certainly the jobs numbers can play an impact on the next short-term trend, but certainly Treasury yields heading lower seems like the path of least resistance. I don't see any reason why we're not retesting those December, January lows at some point in the next couple months.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this research roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the post game, including a number of links to articles that we found really interesting. So you're going to find this and so much more in this week's research roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend, that is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.